Okay, good morning everyone. Wednesday the 8th of March. Let's have a quick chat then ahead of the session today. And just looking since really the cash equity open, which was about half an hour ago, we've had a very powerful move back higher in the DAX index after that initial gap lower in the futures. You can see here in the center left on my charts. Have a slightly lower close again on Wall Street. I think it was the second time we've closed lower in terms of consecutive sessions. You'd have to go back to January of this year. Very unusual to see that happen, but again the loss is fairly small in size, but that fed through into the Asian session with some of those indices respectively following suit, and so therefore we had a mild gap lower, quickly recovered though from the open in the DAX. Likewise, looking at the S&P, we did kind of drift lower really since the close in electronic trade. Bit of selling when Asia came in, likelihood then them just kind of handing on the baton from the negative US close. Bit of selling pressure at the early part of Asian trade before then going really sideways, and a bit of recovery just ongoing since Europe has come in. Quick look yesterday actually with the S&P. Obviously it was pretty quiet overall, and Sam did a pretty good job with the technicals yesterday of just identifying really with not a great deal on the calendar to really sway Fed thinking, that playing the range was probably the more opportune way of looking at the markets yesterday. And that low from the prior day acted as a pretty good level at that point. It was just around the open to get into that trade with the eventual move that we saw over the course of the following kind of half an hour, 45 minutes, went all the way back to pivot before then running out of some steam and then coming back down to that low. Support again, almost went back up to pivot before then eventually breaking, but it took really towards the final half an hour of trade on Wall Street before that really gave way. And you can see the significance technically of that level, having tested once, twice, three times. When it broke lower, then it's kind of opened up a bit of a directional bias to the downside to where we were in overnight trade. So S&P though, I'd still say at this point not looking for any catastrophic type sell-off or correction. Talk of that I think is still very premature at this point. And any dips I do think generally provide buying opportunities when it comes to US equities at this present point. The one thing that which may negate some upside if the selling does capitulate is oil. Now, just looking in particular oil prices at the movement that we saw, this fairly severe candle you can see with the negative close on that time frame was on the back of course, the API crude oil inventories which we had last night. So just to quickly recap the numbers here, you had essentially a build of 11.6 million. Let me just transition my screen so you can see the numbers yourself. A build of 11.6 million. Expectations were for a build of just 1.4 million. So we're almost back. If you look at the charts here of the previous numbers that we've had from the weekly DOE prints, remember that was when we were up at 14 type million. We had a consecutive kind of string of very high numbers on the build side, and then here we are back at that after 2 weeks of fairly benign readings on the headline. So another exceptionally large build for that figure. Cushing was also plus 788,000. Gasoline was the one that was slightly different though. That's actually significant statistically because it's the biggest drawdown for the gasoline number since April of 2014. And distillates was a draw of 2.9 million. So exceptionally large build in the headline, which is obviously bearish for prices, but gasoline, that's more bullish for gasoline specifically, which may negate some of the overall perception of the report. But in terms of market pricing, how it's been balanced out is that it's been perceived to be bearish at this point. That candlestick, you can see you've had a run lower. Just trying to look slightly longer dated, I guess. Downside from here, having already this morning gone through that initial spike lower on the data. It's had a little test of it at the moment. It's kind of failed to really substantially break it. But any move beyond there, then we'll be looking at the lows that we had back on around the 2nd of March on that evening, to then open up any further potential run down to that 52.40 S1 level. So crude to be watched later. Of course, we'll have those numbers to come. Looking elsewhere, sterling currency's obviously been a bit of a focal point again after several weeks of really fairly sideways action. We've seen some further downside pressure. You can see here what we've talked about in this briefings that we deliver when we talked about last week, the timing of the foreign exchange market and when generally the volume starts to pick up when UK and Europe start to come into market. And you can see here pretty tight cluster of price action really overnight in Asia, but then as soon as really UK and Europe gets underway, sort of 6:30 in the morning, then you start to see a much cleaner direction to some of the price action as they interpret some of the news from overnight. The run lower that we've had thus far, we've seen a retest of that low that we had yesterday afternoon. Trying to look at yesterday's session, it did actually provide a couple of opportunities in cable. One thing, obviously, is we've been on a very clear directional trend lower, if you like, in cable, as it's almost if now we're getting closer to the D-Day of triggering Article 50. There's been some slight disruptions going through this final hurdle through the House of Lords, first on that point of EU citizenship, and now with about Parliament having a say, if you like, on a meaningful vote in terms of Brexit. That's drawn some attention. In combination with this, obviously you've had decreasing consumer confidence figures last week. You had the BRC retail monitor yesterday showing a minus 0.4% year-on-year decline in same-store sales as consumers start to tighten the belt. Halifax House Price Index revealed a smaller than expected rise in house prices, so things are starting to snowball slightly from a negative basis domestically for the UK currency. And that's playing out, of course, in the context, if you think about this time frame we're looking at here on the bottom axis, over the last 2 weeks, this is when the Fed have turned uber hawkish, if you like, in order to cement expectations so high, now have 96% probability that we'll have action in March. So you've kind of had a divergence in situations where the Fed have got very hawkish. That's kind of strengthened the dollar view, if you like, in the short term in comparison to negativity that's been growing surrounding the UK economy. Yesterday then we had initially a retest of that low that we had on the 3rd, and then what you had there was a break. Then you had the classic, which then ran lower, and if you remember the time, that's when I managed to get hold of some of that move when it broke the 122 handle, hit some stops, it shot lower before then coming back up to that original S1 level again before pushing lower down to S2. So definitely there was a couple of opportunities there, and looking this morning, that pivot level is kind of sat around there, failed to break this morning, and we've had another run lower here on the downside. Obviously that level at 71, quite interesting. It did see a brief look lower before having a bit of a bounce back, but you would say from a fundamental perspective that the bias probably directionally now for cable is on the downside. So let's have a quick look at that story in a bit more detail. Firstly, about the Lords vote from last night, because the Lords back parliamentary vote on a final Brexit deal. So the House of Lords voted in support of a requirement for the government to bring the final terms of Britain's exit from the EU before Parliament for its approval. So this, of course, the second defeat. Like we said last week, we had the contentious issue about EU citizenship last week. 634 peers voted. This is actually, I was reading a statistic, I'm just trying to recall what it was. It was something like the highest amount of peers voting in a considerable period of time, so a high amount of interest in the situation at the moment. And the Lords backed the amendment to the Article 50 bill by 366 to 268, a majority of 98. So disregarding the warning from the Prime Minister that would undermine her negotiating position. Now, what this has led to was this chap here, you probably recognise, Michael Heseltine. He essentially, what's happened, has been sacked from his role as a government advisor after backing the amendment. So he's basically gone against Theresa May. So he's been fired as a result. Now, this basically just frustrates the process, because essentially it now goes back to the Commons where they have a majority. So this is the situation here. The bill, including the 2 amendments that we've had, now returns to the Commons, where Downing Street is confident and it has the numbers to overturn the changes. One of the things here, though, the Prime Minister has a working majority of just 17 and does face a potential rebellion by pro-EU Conservatives. Opposition aides are estimated that about 20 Tory MPs were considering supporting the amendments. However, obviously, anyone that goes against the government is at risk, like Heseltine, of then being sacked. So whether or not they would do that is yet to be seen. I would think probably not in that kind of size of numbers to go against Theresa May and her government. 17 is a key number, though. That's the working majority of the Conservatives. Now, what has this led to, given the opposition that's been called? And if you think about it, given the severe impact that Jeremy Corbyn has had with the popularity of the Labour Party at the moment, there's been growing calls for a snap election. Is this now an opportune time for Theresa May to strike in terms of calling for a snap election in order to increase then that working majority number of 17 higher, so she can then have a stronger mandate and to carry out this Brexit process as she goes into the negotiating period upon triggering of Article 50. So the Times have released an exclusive overnight. They've said that basically Theresa May is coming under mounting pressure to hold a snap election as cabinet ministers join calls to win a commanding mandate for Brexit. Essentially, this was coming from 2 senior ministers, undisclosed who they were, saying that Mrs May should seize the opportunity to crush Labour and strengthen her hand in exit negotiations, and she should do that sooner rather than later. So certainly this is something to keep in mind that could be a potential scenario for the UK. Okay, some other stories to be aware of. From overnight, you have had China post its first trade deficit in 2 years as imports jumped nearly 40%. That's 40%. So looking at this chart here, you can see the import values in both renminbi and dollar terms, there being the 2 lines that have shot higher, whereas exports have done the opposite. We've had a diverging movement here in this latest trade data. One thing to keep in mind, though, is that this data over this particular measured period, which is February, of course, encapsulates the Lunar New Year holiday, which dramatically provides a seasonal impact on these numbers. So hence the reason why I think the market has really kind of brushed it aside and not looked too much into it. The other thing we've had this morning, and although the timing, the DAX recovery, this came out at 7, so I wouldn't really pin the DAX ramp at the cash open on the back of this, but it is a positive signal, certainly, comparative to the data we had yesterday. So German industrial production has returned to growth in January, you can see here. But one thing I'd keep in mind, really with the factory orders, we saw the same yesterday, is that apart from the actual financial crisis period where we had some degree of consistency at least, albeit negative, this data does tend to swing quite wildly month to month. If you look at the prior month's data, we were down kind of -3. Now we're now up at this latest reading over above 2. So quite wild swings, but a positive swing nonetheless. This, of course, follows the worst month for factory orders since 2009 for Germany we had yesterday. So welcome relief that the IP number is a little bit firmer in that respect. Quick look at the calendar for today. Looking at the morning session, actually it's very quiet overall. We do have, though, a key bellwether indicator for the US ahead of non-farm payrolls. that being the ADP employment change. That's expected at 190,000 today. Quick look at ADP. If you remember, last month we had 246,000. That was a massive blowout figure. If you remember, that was expected at 165,000 when that figure came out. It was the best jobs gain seen in 7 months the last time round. Now, people obviously are looking to non-farms, as well as the week after we have the CPI data as the final kind of jigsaw pieces for the puzzle in order to cement not just the March hike, but then what will the communication be, how hawkish could it potentially be, will be defined by how strong these economic data points are. So really, you're viewing this number to bed in then the expectation for payrolls, but ultimately I don't really see this data deviating from the script, which is the fact that we're on track in terms of the Fed and the performance of the US economy at the moment. The other thing, of course, looking at the calendar, you have the crude oil inventory numbers. We'll look at those later. The benchmark being then we've had a bearish interpretation, fresh lows down 50 cents in WTI on the back of the APIs last night, with a pretty huge in excess of 11 million build on the headline figure despite the draw in gasoline. And then the other thing that will draw some attention, certainly from a media point of view, is the UK budget. Just having a quick look at the preview here from the guys at Ransquark, because really they're looking at it more from a market's point of view, which is important because despite all the fanfare that you generally get with the budget, obviously in terms of the tabloids, this will be main headline news both today and tomorrow morning for sure, because it essentially is what impacts the everyday man on the street. But from a tradable point of view, really it offers very little. Looking at the main things that you're looking out for today, the OBR, which is the Office of Budget Responsibility, which is essentially an arm of the government, they're touted to raise their short-term growth outlook, but warn about remaining uncertainty in the medium term. So the FT has suggested that growth forecast for 2017 could be revised higher from 1.4% to 2%. Now this is very much priced in. If you think about the Bank of England's last quarterly inflation report, where they hiked the growth forecast, that had completely zero impact on the market, where the focus was on, at that point, the lack of movement to the upside in their inflation forecasts. So very much the OBR, like the Bank of England, had underestimated the robustness, if you like, of the UK economy to perform post-Brexit, and so an upward revision to growth is completely, I'd say, priced into the market. From a trading point of view, for those who haven't really looked at this before, from an FX perspective, it doesn't really throw up too much really that's outright tradable. Talking about public finances is generally being factored into the market because we see data on a regular basis, and the Chancellor has been very vocal in his communication over the recent week. From a fixed income point of view, there is actually, just to note, a trading opportunity if you do trade gilt futures, and that's when they outline their terms of financing requirements, which is basically their gilt issuance over the period ahead. So this is when you're basically trading on the basis of supply and demand, on whether they're increasing or decreasing the gilt issuance over that period of time. But very much just affects gilts, doesn't really have a read across into bunds and what we're looking at in T-notes. Otherwise, it's very much more a single stock event, and by that, things like tobacco names come into focus. This is obviously, there's a few listed in the FTSE. Chancellor could force a minimum price upon cigarette makers. Insurance names could fall into focus given the attention given to social care. Other focus points can be housing names, airlines, gambling names, depending on legality really around those particular sectors, and any movement on taxation on those particular areas can affect then corporate profitability for those firms that operate within that. So that's how I'd kind of view the budget overall. Timings wise, you have the regular PMQ session which commences at midday. The Chancellor then takes the stand at 12:30, and then he'll speak for roughly around an hour, the longest ever budget speech you have to go back probably about 125 years, was about nearly 5 hours long. Those days are long gone. The shortest one was about 45 minutes. So really, usually they tend to last about an hour. They'll be playing across Bloomberg. I would have a listen to it. I don't think you'll be looking though for an outright sterling trade. It's more, if you're looking at the FTSE, potential sector impacts could move the index. That's how I'd kind of tackle that release. So that's pretty much the morning briefing then. Just been looking at the charts again. If I just transition over, T-notes have just crept a little lower here again. Fresh session lows, you can see here down 5.5 ticks, just as the equities have seen this recovery since the cash open. The S&P starts to claw back some of those overnight Asia Pac losses. Likewise then, with yields rising, the dollar's a little bit firmer, both pairs under a little bit of pressure, and then likewise dollar also under some selling pressure as well, having already gone through that low print seen from yesterday afternoon. So despite the slight gap lower in the DAX, now starting to see an emergence of some mild risk on coming through, and it's the traditional kind of play, I guess, with the Fed expectations of being more hawkish coming up in the context of more nervousness, I'd say, on the UK domestically. So you've got a firmer dollar weighing on gold, oil as well lower with the bearish report last night, so higher US yields. T-notes are moving lower as well. Okay, have a good session then. As I said to some of the guys yesterday, pretty quiet morning. Seeing a little bit of movement here, keep an eye on, but likelihood you're going to be wanting to wait until the US come in to derive a little bit better price action, like that we saw yesterday with the open, with the movement in the SPOOs, and then some of the corresponding movement seen in other asset classes as well. Okay guys, have a good day, good luck in your session, and I'll see you in the chat room.